Have you noticed the number at the gas station ticking up faster and faster? It's a feeling many are sharing across the country and around the world right now. You pull up to the pump and the final bill is noticeably higher than a few weeks ago. Food seems to cost more at the grocery store. Heating your home is digging deeper into your budget. Many are asking the same profound question: why is this happening now? The answer connects a distant war, a vital shipping lane, and the very nature of the money we use every day. This essay will explain how events overseas can directly impact your daily life. The story begins on February 28, 2026. Surprise operations against Iran sent shockwaves through political and economic systems. One immediate consequence was the effective closure of the Strait of Hormuz. When it becomes impassable, a massive portion of the global oil trade simply stops. Markets reacted swiftly. Traders bid up oil at a historic pace. This chain reaction became the largest energy disruption in modern history. We will break down money supply and inflation, and connect oil to your costs. The Strait of Hormuz is a small but mighty channel connecting the Persian Gulf to the open ocean. On a map, it looks insignificant, a mere sliver between Iran and Oman. In reality, it is the world's most important oil transit choke point. About 20 million barrels pass through daily in normal times. That's roughly 20% of world consumption and 1/5 of seaborne trade. If it's blocked or unsafe, the energy market holds its breath. Flows can slow to a trickle, stalling a huge portion of supply. Producers ran out of storage and curtailed output. The IEA called it the largest disruption in the oil market's history. Prices surged faster than during any recent conflict. Panic not seen since the 1970s energy crises. By March 8, Brent topped $100, later peaking above $126. U.S. gasoline hit $3.91 per gallon, up 93 cents in weeks. This is a classic supply shock: fewer barrels, higher prices. Demand is the same, but capacity vanishes. The jam drives prices up. Importers, especially in Asia, scrambled for alternatives, pushing prices up everywhere. To understand how oil fuels inflation, first grasp the money supply. It's the total amount of money in an economy: cash and coins, the cash in your wallet, the coins in your jar, and the much larger digital balances in bank accounts. Using a card or paying online uses the digital money supply. Central banks manage this supply to keep the economy healthy. Think of a marketplace. Money supply is all cash and credit available to shoppers. When central banks expand money, spending and hiring can grow. More investment and jobs help the economy. But if money grows faster than goods, demand pull inflation can result. Wars force rapid government spending, operations, industry support, and aid. Creating money without more output expands supply. More dollars chase fewer goods, especially when critical supply chains like oil are disrupted. It's a delicate balance. Too little money risks recession, too much erodes savings. In 2026, the world faced a double whammy: potential money growth and a severe oil shortage. This set the stage for a challenging bout of inflation. Inflation is the rate at which prices rise and purchasing power falls. 5% means $100 becomes $105. Cost push inflation starts when essential inputs, like oil, get pricier. When crude spikes, the first hit shows up at the gas pump. Gasoline and diesel costs rise because crude is their main ingredient. Everything you buy rides on trucks, trains, ships, and planes, all fueled by oil. Transport fuel costs pass through into shelf prices. Energy is a base cost across industries. Higher energy raises goods prices. Farms use diesel, fertilizers linked to gas. Higher energy means higher food prices. Factories pay more to run and heat. Manufactured goods rise. Even services rise as commuting and utilities get pricier. In March 2026, Brent surged above $100. Analysts estimated a $14 risk premium per barrel. The broad price rise strained households and challenged central banks. Their primary tool to fight inflation carries risks. The Federal Reserve's job is to maintain price stability. Raising the federal funds rate makes borrowing costlier economy-wide. That cools demand, easing price pressure back toward target. Before the war, cuts seemed possible. The oil shock changed everything. Higher oil lifts near-term inflation, complicating the path forward. Forecasts moved to about 2.7%, reviving stagflation worries. A crucial piece is the unique role of the US dollar in the global oil market. For decades, oil has been priced and traded primarily in dollars, the petrodollar system. When countries sell and buy oil, transactions are almost always in US dollars. This creates constant global demand for dollars, supporting its value. A stronger dollar makes imports cheaper for Americans, helping restrain inflation. It also lowers US borrowing costs via deep, reliable treasury markets. When oil prices spike, global demand for dollars jumps too. Importers suddenly need many more dollars for the same oil. The scramble can strengthen the dollar further. That strength can mean real pain for developing economies. Some have tried to trade oil in their own currencies, but dollar dominance remains. The system is deeply intertwined with the dollar. Change is slow and difficult. In sudden crises, markets flock to the safest, most liquid asset, the US dollar. Dollar strength during an oil shock creates a double bind abroad. At 20 pesos per dollar, an $80 barrel costs 1,600 pesos. After the shock, $110 oil and a weaker currency mean 2,650 pesos per barrel. Not just a 37.5% oil jump. Over 70% in local terms drives rapid inflation. Imports, food, essentials soar. Firms raise prices, cut output, or lay off workers. Governments can release strategic reserves to cushion supply losses and cool prices, work with allies diplomatically and militarily to secure tanker passages, provide targeted relief for vulnerable households facing higher energy and food costs. Central banks should act decisively but not rashly, coordinate and anchor expectations. Households can drive less, combine errands, use public transit and lower thermostats. Tighten budgets and if possible build emergency savings. Small steps multiplied across millions can ease demand and pressure on prices. Panic is a poor advisor. By understanding oil, money supply, and the dollar's role, we can navigate this crisis and build resilience for what comes next.